Let's move on to our next segment, though, which is the wrap of the week. So every Friday, we like to take a longer-term view at the market environment, think about it as a long-term investor. And again, one of the things we talk a lot about in the show are routines and connecting the short term to the long term. And Friday is the time to do it over the weekend. Is a great time to take a step back. So we're going to use the Mindful Investor Live chart list for this for a lot of the way. If you've not gotten to this, if you've not seen this before, go to the Mindful Investor blog on the articles tab here. Go to my blog, and you'll have a link at the very top to go to this chart list, which you can install on your own account. We're going to start with the long-term market trend. So again, remember this distribution that we felt over the last 48 hours is a little tiny blip on this long-term trajectory of the market. So let's keep things in proper perspective. Overall, the long-term trend has been positive. And the signal I'd be looking for is here at the bottom. This is the weekly PPO, or the weekly MACD is very, very similar. And this is showing you sort of the medium-term or the intermediate-term trend in the S&P 500. Until we get a sell signal where it breaks down sort of what we saw here at the end of January of 2018, that's when it tells you the uptrend is starting to break down. We have not had that yet. It's still in bullish territory. So we would need to see more of a sell-off for that to really register as a negative sign from that longer-term view. We've looked at this chart a lot recently. This is looking at the breadth along the cap tiers. Again, today we had a situation where sort of everything came off. It wasn't like small and mid caps were up while everything else was down or anything like that. Everything sort of sold off in a very similar fashion with some exceptions. But overall, these breadth readings will most likely turn lower. Overall, I think we'll still be in a position of caution. But just based on what I'm seeing at a high level, it appears that the long-term breadth on the largest companies remains the strongest. I don't think that would change in any way based on what we saw today. You know, it's been interesting looking at the new lows on the market. This is the New York Stock Exchange. You can see that we've had a token number of new lows. That was different from sort of December, January. This 2-month period, we had almost no new lows and no new lows on the S&P 500 for most of that period. All of a sudden, we started to see an increase here in the end of January. That's when the market pulled off a little bit. Started to see some companies start to break down. And again, it's energy and some other defensive things. But, you know, again, it had been a situation where nothing was breaking down. Now you started to see a bit of an increase. So we've had some, not a ton. And on the S&P, it's been, essentially zero. Most, if not all, S&P names remain making new highs or not making new lows is what's most important. It'll be interesting to see if and when we do see a deeper correction, how much we see an increase in new lows, because it's been a while since we've had a meaningful number of new lows on the S&P 500. We haven't looked at this chart actually in a little while. This is looking at the percent of stocks in the S&P 500 that are above their 200-day moving average and above their 50-day moving average. It's interesting that with the sell-off this week going into Friday, still 2/3 of S&P names are above their 50 days. So, that had peaked out just above 80%. It was around 85%. It got above 90%. At the beginning of last year. So overall, it's been much more elevated than it was recently. But still, 2/3 of stocks are still above their 50 days. So, again, it'll be interesting to see if we see a follow through next week, if you see the S&P go lower, go below its 50-day, how many stocks are also going below there? And it's rare that we've been relatively weak in this indicator for quite a while. It's been fairly elevated. 4 out of 5 S&P names are still above their 200-day. There's a long way to go. If you look, the S&P would have to go below 30, 40 to break its 200 days. So there's a lot of space there. It's actually very extended relative to its 200-day moving average. The concern there, along with the bearish divergence, is if you look back at times when it's been this extended, it's something like the beginning of 2018 where you got so far away from the 200-day that it felt like we had to have a reaction sell-off and come back down to earth, if you will. So, again, it's just the early days of a potential pullback, but interesting to see how this is lining up with some of the previous peaks that we've had. In terms of sentiment, the AAII readings really didn't change a whole lot. We didn't talk about this yesterday because it wasn't much of a factor, I don't think. Similar number of bulls that really didn't change. It's about 40% of respondents still bullish on the S&P. An increasing number of bears. So all that means is some people went from neutral to bearish, but just a couple percent. So overall, remaining in a similar sort of situation where definitely more on the bullish side than the bearish side, which is, again, actually consistent with a lot of healthy bull markets. It's not really giving you a warning sign of extreme bullishness by any means. One of the interesting charts I would think about in terms of sector rotation, we're going to rotate to that here in a moment, is looking at the consumer space. One of the charts we talked about at the CMT meeting last night, it's interesting how this ratio, looking at the cap-weighted consumer discretionary versus staples, has gone up, pulled up back a little bit today for sure, but this is really weighted towards Amazon dominating consumer discretionary. If you take the weighting of Amazon out of there, it's actually kind of a meh, kind of leaning more toward the defensive side of the ledger, but really has been flat for the last month or so. So this is consumer discretionary relative to consumer staples, equal weighted, so it's sort of equal weighting all of those names. So this tells you the average staple stock has been outperforming the average consumer discretionary stock year to date, and that trend still remains leaning more towards consumer staples. Feels a little more defensive than offensive, in my opinion. You know, looking at the weekly RRG, I think it's interesting to see a lot of pretty severe moves. You can see technology, the XLK, remains by far the strongest out of all the readings. Other noticeable movements have been utilities and real estate, which are accelerating to the northeast. And again, in general, things going to the northeast tell you there's an improvement in relative strength. And those are the areas you want to tend to look for opportunity. Interesting to see consumer discretionary, but again, that's a big weight of Amazon that's pushing that higher right now. On the downside, you see healthcare that had been one of the top sectors rotating down into the weakening quadrant heading southwest, which is more negative, and financials have now completed the transition down into the lagging quadrant, down with things like materials and energy and industrial. So really following through on that issue. One of the questions in the mailbag, if I remember, was relating to banks and just what, you know, the participation of banks. And certainly we've seen the XLF not participating as much on the upside, and now based on the RRG work, really completing that transition. So we've had a bit of rotation, but it's interesting to see technology remaining pretty strong. Now, again, this is based on longer term weekly data, so it'll take a little while for a sell-off in tech to be registered on a chart like this. The intention here is to keep geared toward the long-term trends. The last thing I'm going to look at as part of our weekly review, and again, as always, I feel like we could spend so much time with all of these, so I'd encourage you to use this as an inspiration for a deeper work that you can do over the weekend, in the evening, whenever you have a good opportunity. But I like to look at the scooter reports, look at the industries, look at the 1 week changes, and first we'll look at the strongest sectors. So at this point, automobiles, this is Tesla's group, computer hardware, that's Apple's group, if I remember right. Software, so it's a lot of tech. Home construction has the home builders in there. Semiconductors, one of the top 10. So still, even with a bit of a pullback, holding up very nicely. But let's look at what's moved over the last week. The big story, I think, are the gold stocks, the gold miners, the mining names. When we look at the chart of gold, you can see it's broken out significantly. Could be a safe haven play, absolutely right. But certainly in a situation when everything has been in an uptrend, something has to disagree, something has to change. And today and yesterday sort of feeling like equities potentially being the weaker option, something where we're going to see some weakness. I'd also encourage you, we don't have time to go through the ones that are down, but a number of healthcare spaces in here, also some industrial, so defense, aerospace, some household products. This is within staples. So make sure you look at those names, and if you have exposures or if you're looking at those groups, make sure you're aware that there's been a lot of negative movement relative to the other industries out there. That's our weekly wrap for a Friday afternoon here in late February. We're going to take a quick commercial break. We're going to be back answering your questions from the Final Bar mailbag. We'll see you in a minute.